Hi everyone, welcome back to my channel. If you're new, then a massive welcome to you. My name is Dr. Baptiste. I am a portfolio GP or a GP with a portfolio career. This video is the first of a 4-part series where we talk all about money, we talk all about the financial aspects to working as a doctor, things that you really need to know. We will be speaking to John McCaffrey, who is a tax partner at Alexander & Co., which are chartered accountants, tax advisors and business consultants, all specializing in working in the medical profession. As medics, we don't often talk about finances, but talking about finances and understanding finances is so important to our medical careers and our personal lives. Money and finances affect everyone. And for us as medics, it can be incredibly complicated when you start thinking about employment structure and the NHS pension scheme. So, John is going to be answering a number of questions that are going to help you on your medical career journey. As always, if you enjoyed the video and want to see more, then make sure you give it a thumbs up and subscribe if you haven't subscribed already.
Alexander & Co. has been around for around 40 odd years now. We specialise in dealing with business owners, entrepreneurs and family-owned businesses. Medics in the medical profession are business owners, just like any other. There's some issues that are particularly relevant to medics in terms of tax and finances, but they are by and large business owners. We work with several medical professionals across a range of fields, and we help them arrange their structures and income so that they are tax efficient in terms of things like income tax, capital gains tax, and also with an eye to the future in terms of potential inheritance tax planning. Medics will start in a number of ways. Medics either generally will be working with NHS, and they will have salary income. They'll also have an NHS pension, which is a particular type of pension arrangement. In terms of that type of arrangement, it's relatively straightforward. They will be subject to tax on their earnings as they make it, and they will have a pension pot building for them. Now, there are certain limits on your pension pot building, and that comes into other areas, because as careers develop, a number of medics will then look either to do private consultancy work, or they may work with sports teams, or they may become specialists in their field, and they may do consultancy work in things like legal cases, which will then be run as separate businesses. Now, in terms of that, there are a number of factors to consider. One, it's your income, and you have to live off it. But secondly, as you're earning more and more income, the tax rates and charges go up. And looking at certain types of structures may help you be more efficient in those, in saving tax in those areas. Also, you may wish to make investments or savings. Some might buy properties, some might put portfolios, some may put more funds into pension. And if you breach, which several medics do, say halfway through the career, if you breach the limit in terms of what you can put into pensions, there can be some pretty significant tax charges. So it's all about getting some early stage planning so you can make informed decisions about how you want your career to go, how you earn your income, and how you plan for your future. So definitely the medics I work with are running the arrangements as a business. It's quite similar to an accountancy practice. You are selling your knowledge, and your knowledge has a value, and people are willing to pay for that. You definitely need to say it as a business, because otherwise you will find yourself paying taxes that you didn't want to tax, and working hard basically to hand over additional funds to the government that you may not wish to have done. I would engage early with 3 professionals. One, I'd engage early with an accountant to make sure that you are informed as to how to record your income and expenses, the things you are allowed to claim, and that either you're competent yourself in being able to record that income and expenses, or you've got somebody doing it for you so that you can get all your relevant accounts and tax filings in. I would think that if you have available cash, you should also engage with a financial advisor to look at investments and pension structures. And you most certainly need to engage with the legal practice in terms of setting up your business structures, personally in terms of wills and succession type planning, and also to make sure you've got the right insurances and medical negligence cover in place. Medics will operate in a number of ways, similar to a lot of other businesses actually. So you can be employed. If you're employed, you earn a salary, and then that salary is taxed by your employer. You have your net income, and that's largely it. It's very straightforward. It's not particularly tax efficient because all of your income is taxed as you earn it, but it suits a number of people. In addition to that, you may be what's called a sole trader. And what that means is that you are selling your services, but outside of any formal structure like a partnership or an employment or a company type structure. And again, you will have to, in that, you have to do an annual tax return supported with a set of basic accounts, and you will pay your taxes based on those accounts and your income and expenses in that particular tax year. Following on from that, you may set up in a partnership type arrangement with other medical professionals. Partnership is a little bit more complicated than being a sole trader, and there is commercial benefits in terms of there can be a certain element of limited liability. Also, there can be some sort of collective purchasing power in the whole of the partnership. But for tax purposes, partnerships are what's deemed to be transparent. And what that means basically is you are taxed in the tax year on your share of the partnership profits. There's some funky calculations required to work out how that is done, and there are some issues on joining and leaving the partnership that you need to look carefully at. But broadly, it's quite similar to being a sole trader. And finally, you could work as selling your services through a limited company. Your company would engage for your services with your clients, your end users, and the company would pay corporation tax on the profits it makes on your services. There are a few issues with this. One, it's great because the corporation tax rate is generally lower, but you need to factor in that actually getting the cash out of the money can lead to other taxes in terms of you being paid a salary or a dividend. This might be able to be managed by splitting it with, say, a spouse who does some work for you, or a spouse could be a shareholder and you might be able to take dividends each, which would overall reduce the tax rate. There is a lot of talk at the moment about medical professionals, and this has been around for about 3-4 years now, working through companies when in fact the relationship with the end user, the hospital, the person, is a long-term contract and would be considered to be employment. In those cases, and if that particular legislation applies, it's known as IR35, but in that you would end up getting taxed on PAYE anyway. But the company structure can work if, say, you're running private practice or doing working for a number of clients, and you don't want to take all the funds out of the company. It can be a particularly tax efficient route. Is there one particular route? No. I think where we find that we advise well is that the route needs to be tailored to the individual's circumstances. So the individual's got to be able to operate commercially in whatever route they decide to do, and they've got to be able to live their lives, because at the end of the day, what they're doing is their income for them to live off. So we tend to try, and you should try and tailor your structures to a situation that suits you best and actually suits any changing circumstances you might have coming up as well. But there are pros and cons with each particular structure. If you're employed, it's simple. Your tax is taken from you, from your earnings, and it's that source. The con with that is actually if you're earning quite a lot of money, it can be quite a lot of tax. Being a sole trader, again, relatively simple. No need for accounts in terms of formal statutory accounts. And it's quite liberating in terms of the fact that there are no formal structures around you. However, you are taxed on your income as it arises, and you need to be a little bit careful with being a sole trader in terms of the fact that if you're sued, there's no limited liability which partnerships and companies can offer, but insurance may well cover that. However, you need to be very, very careful on your insurance policies in those cases. The partnership can offer a limited liability, but as mentioned before, not that much different from being a sole trader, as you're taxed on an arising basis. and the company does work to reduce taxes if you don't extract all the funds from the company. But with a company, you do have the added complications of you will need to do a set of company accounts, you will need to do a company tax return. There are certain filings you need to do for a company. And it's whether or not we wish to incur that admin and expense. Yeah, no worries. A locum chamber could be one of two structures. So a locum chamber is actually a bunch of individuals who work together with a central costs allocated between them. In that case, you are just a bunch of sole traders, but with central costs being incurred, and what you'd be able to do is to take a deduction for those central costs, provided the tax deductible. But you'd be able to take a deduction for things like the rent of the chambers, the various costs you incur, secretarial maybe, resulting in your profit for that particular year. It could also be structured as a partnership structure, whereas you're in a locum chamber as a bunch of partners. In those circumstances, it's very similar, except the partnership will be required to do a tax return and file a tax return. But the partnership is not responsible for the tax. That tax is then allocated out to the individual partners. When there are some high-earning doctors out there, and there are some with a variety of different activities they undertake. Outside of tax, one of the key benefits of the company is the limited liability. So if, say, you are involved in medical negligence type legal work, or expert witness type work, then it may be beneficial, not just then, but also if you're doing a number of private clients, a limited company might be a beneficial structure. As I say, if you're making a decent amount of money that you don't need the full amount, you could use that limited company to reduce your tax bill. You could have varying different shareholders. So if you're married, your spouse would be able to take a dividend from the company, which may save you some tax. There are some costs associated with a limited company in terms of fees and filing requirements. But it very much depends on your individual circumstances. The main issue at the moment is whether you're using a limited company when in fact actually you've got a single contract and it would be deemed to be an employment relationship. In those circumstances, limited companies aren't great because purely from a tax point of view, the whole of the income would then be subjected to PAYE and national insurance. But even then, the limited company legally still provides the limited liability aspect, which may be beneficial. Tax and accountancy is based on basically tax year ends or a company accounting year end. So if you are a sole trader, generally you would do your tax return for a tax year. Tax year runs from the 6th of April one year to the 5th of April the next year. You would be required to keep a record of all your income and all your expenses and return this on a tax return and ultimately pay tax on the profits. It may be beneficial to engage with an accountant because there are certain expenses they may be able to identify that are tax deductible and you haven't. And conversely, they may be able to inform you of expenses you are thinking about claiming but can't actually claim. Now, partnerships and companies are a little bit different. Partnerships and companies, partnerships particularly, the partnership does a tax return based on its accounting period end within the tax year. So partnerships are required to draw up accounts, and your tax position for that tax year, apart from the first couple of years of when you join and the year you leave, are based on when that accounting period ends within the tax year. But it's very similar in that the partnership will draw up a tax return, and again, you would need to keep a record of your income and expenses for the partnership. I would recommend in all cases an accounting package if your business. Excel is fine if you're able to manage it that way, but as businesses grow, an accounting package is much more useful in that it allows you to tie into your bank account and reconcile cash amounts back to invoices and that kind of thing. Plus, your accountants can generally log in online. Plus, the world of tax is going increasingly more digital. And over the coming years, there will be more filing requirements for both partnerships, sole traders, and companies in terms of something called making tax digital. So if you've got an accounting package set up, that will make that transition a whole lot smoother. Companies very similar. You need to get some legal work. You need to incorporate a company, and you probably need some legal work to make sure that the company is engaging for your services rather than you engaging directly. And again, I'd recommend an accounting package of some description to record the income and expenses of the company. But in all cases, it's just a question of making sure that you're accurately recording who pays you what, that you've got invoices in place for that, and that you are recording your expenses and ideally have evidence to support those expenses. As an individual, if you're employed, you're only required to submit a tax return if you earn in excess of £100,000 a year. If you're comfortable doing your own tax return because it's just a PAYE entry, then fine, but there are potentially other expenses like subscriptions that you may be able to deduct. It's also fair to say that doctors are incredibly busy people, so they may find it easier just to engage with an accountant to file their annual tax return. If you are going to be doing other businesses, starting as a sole trader or a local chamber or within a partnership or a company structure, I would definitely recommend you engage with an accountant in some way just to make sure that you set up those structures in the correct way and that you're aware of your obligations. Accountants can generally help you with all those obligations. If you've got the time, if you feel confident, there's no reason why you couldn't do them yourself in a number of cases. I would say if you're a company, doing your own statutory accounts and your own corporation tax return will be a bit more tricky. But if you're a sole trader and quite happy with your income and expenses and completing a tax return, you can do that. But again, accountants, just doctors are experts in their field. Accountants are generally experts in accountancy and taxation. You would probably, in a lot of cases, find that the job was done more thoroughly. And the tax return needs to be done based on the tax year ended the 5th of April, and again, it needs to be submitted by the 31st of January following. If you're in a company and you've received dividends, you will also need to return them based on the tax year dates. IR35 is a messy piece of legislation that the Inland Revenue introduced, way back in 1998. They were aware of the fact that a number of people, a number of businesses, doctors, medics, IT contractors, and construction industry were structuring their arrangements so that they weren't considered to be employees, but that they were offering their services through a company. And the benefit of that to the individual was that the company pays corporation tax at a lower rate. And then if they're able to have differing shareholders, they can split the income between a couple of people and significantly reduce their tax rate. Now, the revenue looked at this and said, well, if the company wasn't there, actually, given that you're working more or less wholly for one individual, and they're providing you with a range of benefits, say, you would be deemed to be an employee. In which case, you would be solely taxed and there would be a national insurance charge. So the revenue was losing a great deal of tax. Under IR35, what is meant to happen is that the individual company would be taxed for PAYE. But the problem with that is that there were hundreds of thousands of these individual companies. The rules were a little bit woolly, and the revenue spent vast amounts of money trying to take prosecutions, which often failed. So back in 2017, the rules of IR35 were changed slightly. And in situations whereby you are providing your services through a company, and in the absence of that company, it would be considered an employment relationship, it is now up to your client to decide whether you are employed or not your individual company. And if they do so decide, then it is up to either the client or whoever it is paying you, which may be a recruitment agency, to operate PAYE. There is technically a right of appeal against that by you if you don't think you should be subject to these particular rules. However, it's up to the client to decide the appeals process. And also there's the commercial factor of the, well, if they've decided you're going on payroll and say you're not going to get the job unless you go on payroll, it's whether you refuse the income or not. So that was introduced in 2017 for contractors working through companies for public sector, such as the NHS. And from the 21st of April this year, there will be a similar arrangement brought in for the private sector. So if there's any sort of long-term contracts with hospitals, private hospitals, they will be caught by these new IR35 rules as well. Advise that you speak to a financial advisor about pensions. I'm not allowed to give advice around pensions and investments. What I can say is that there are a number of tax implications with pensions. So doctors working in the public sector generally have a pension through the NHS. It's a particular type of pension, which means when you retire, you get paid a certain amount of money. You can generally pass on 50% of that pension to your spouse if you pass away before them. But also, a number of doctors may want to consider private pension. Now, there's a couple of issues with it. Was brought about by doctors, but it affects everybody. So, if your overall income in a year is more, I think it's about 200,000, inclusive of any pension contributions, there is a disallowance on the amount of pension that you can put into your pension pot for a particular year without paying tax on it. So generally you can put up to £40,000 in a pension, but that amount starts to taper off if your income is over, I think it's about 200, 210, something like that. In which case, if you are finding that you're making pension contributions, and in particular with the public sector ones where the contributions are automatic, you might find yourself paying tax on that. So it's definitely something to keep an eye on. Secondly, if you've got your own company and that company operates well for you in terms of it's a genuine company and it's not caught by IR35, your company can make pension contributions on your behalf as an employee or director of that company. And again, it's up to the £40,000 a year, subject to the rule we just discussed about the upper limit on earnings. But the company can take tax relief on those pension contributions. Overlying all of that is that there is a cap on the maximum amount you can put into pension during a lifetime. It's around about £1 million, but sort of increases with inflation year on year. If you breach that cap, then when you draw down your pension, there can be up to 55% tax charges on the surplus that's being drawn down. So there are a few issues to consider, but I think it's very worthwhile if there is cash around. Pensions can be very tax efficient. As I say, there's corporation tax deductions available. If you're making personal contributions, there are income tax savings to be made on those contributions. And from an inheritance tax point of view, if you don't draw down on your pension, and this is private pensions only because you can't do this with NHS pensions, you can pass that on to your beneficiaries in a manner free from inheritance tax. We are a Manchester-based practice. However, we've got a website which is www.alexander.co.uk. On there, if you go online, there is contact numbers and many places where you can find a contact form. You can either do a general request to the practice, or you can ask for me, John McCaffrey, and I'll make sure one of our tax advisors gets back in touch with you around your issues.
I hope you found that video useful. Like I said, this is the first video in a 4-part series, so make sure you stay tuned for the other 3 videos. And as always, if you enjoyed the video, then hit that like button and subscribe if you haven't already. I will see you in the second episode.